All right. Hi, this is James Zhang with Full Capital. And today, at the very beginning of November 2020, we're going to do a little bit of sort of where we are in terms of the economy, collections, sort of what investors are seeing, and then really jump into the types of multifamily loans that investors are using right now. And then talk about sort of what we're seeing and then answer any questions you guys have on the multifamily financing, investing environment right now. Just a little bit about me. Born and raised in Houston, went to school in Austin at UT. Been up here in DFW since 2006. I was an underwriter for G Capital for 10 years. And then the last 5 years have really focused on multifamily originations. And then also have invested in probably about 28, 29 properties on the multifamily side in DFW, Austin, and San Antonio. 6 or 7 of those have sold in the last 2 or 3 years. And right now in about 21 properties across those markets. So this came out of RealPage, and I sort of start with, employment is going to drive demand for apartments, and that's going to lead to rents. And so you can see that, when the economy shut down in, late March, early April, all the markets got hit hard. So this is just a snapshot for the Texas markets. You can see, in Austin, down 11% unemployment, and then now it's come back to just down about 4%. And so Austin, Dallas, Fort Worth have recovered faster. And then you can see sort of on the bottom left, DFW and Houston in terms of the absorption of really that's, to me, that's really new product, but the absorption has continued in DFW, Houston, and the other two, Atlanta and Phoenix, has continued to absorb in Q3. And you can see the biggest negatives in San Francisco and New York, which I think most people know already. I guess this is the big thing in terms of rents, right? So how is this impacting rents? And we're seeing a decline in Austin, in Houston, and then even San Antonio. And Dallas Fort Worth is actually doing the best out of all the 4 major markets. And I was looking for the slide. I needed a 4th slide here. But when you cut these rents by class, A, B, and C, it's almost negative in A, B's are flat, and C's are positive still right now. So this top right is really a blend of all classes in those markets. And so like when you look at collections right now, I actually just pulled this down this morning in 2020, you can see sort of year over year, collections have been declining steadily. I'm not sure what this anomaly is in October. I know that a lot of people were being super late on payments, and they saw a pretty good pickup here at the end of October to be at 95%. But I've seen sort of across the portfolio that I'm invested in, majority of the delinquencies have increased. The one positive is that there are some ways of evicting tenants right now where that is getting people who have been in since March. At least that threat of eviction has allowed them to just move out since they haven't been paying since March. And collections overall, I mean, it looks like Austin, DFW are doing the best, and Houston and San Antonio are struggling a little bit more on collections overall. But this chart, I think, is more, if you start sort of on the top right, this is the federal funds rate. And the last time we went through this recession, they took the federal funds rate all the way down to 0. It stayed there for 7 years. And then we started bringing it back up in 2016 up to, 2.5%. And that corresponded to the 10-year treasury as well. And now we've brought it all the way back down. So most people, if you move down to the bottom, most people are forecasting that to be flat for the next 3 years and then a pop up over time. And on the top left, I guess this is going a little bit opposite. On the Fed side, they were pretty slow to respond to the last recession, but this time they brought it very quickly in terms of the amount of money that they injected into the system with the stimulus. So we're waiting for one more stimulus, but depending on the election and how things go tomorrow, we'll see how that stimulus comes through the government. But I mean, this is what's really driving a lot of the demand right now, is that the 10-year treasury has essentially gone down to 0. And, it's at 70, 80 basis points right now, and your cap rate's still at about 5%. So that spread between the two is what's driving a lot of the investment dollars right now, is that if I can get a 5, 6, 7% cash on cash, I'll take that, versus 0.001 in my savings account. And this is probably, this is a chart from Marcus Millichap, is the downtown versus suburban aspect of these apartments. And, majority of the investors that we work with, they're buying stuff in the suburbs, right? So the outer ring of DFW, the stuff built in the 60s, 70s, and 80s versus the new stuff downtown. And you can see that this trend has finally, it was in process, but now it's significantly different in terms of downtown versus the suburbs. And so, when you're looking across multifamily financing, these are really the 5 main loan types, starting on the left-hand side with bank loans, and then going into Freddie and Fannie, and then non-recourse bridge as you build more experience and take on more challenging deals. And so we're gonna talk about all 5 types today, but we're also gonna spend a little bit more time on this Freddie Mac conventional versus Fannie Mae, because that has created a little bit of a change on what people are doing in those 2 loan types. So this is a deal that we did, 250 units, $26.5 million purchase price over in John Pry's neck of the woods over in Bedford. And they came to us and sort of said, look, we're looking at 2 different ways. Which way should we take it? So we gave them 2 quotes. One was sort of on the Fannie side and one on the Freddie conventional side. And, on the Fannie side, 20 million, you're probably 2.5% to 3% on the interest rate, depending on your loan term. Yield maintenance, you could do a 10-year with 9.5 years of yield maintenance, or 7-year yield maintenance. 7-year yield maintenance, as we'll see in the next couple slides, is, it might add 15, 20 basis points on your interest rate. This would be Fannie Mae approved with sort of a DUS lender. And then Freddie, you have to go up to Freddie to get it quoted. It's 20 million also, 2.75 floating. You have to buy an interest rate cap every 3 years. Minimum is 3 years. You have a 12-month lockout, 1% prepay. And then your net worth is only needed to be about $10 million. And so they decided on the Freddie floater on this one. And the reason being really this prepay. So this 12-month lockout, 1% prepay. And they went out and got an interest rate cap. So the interest rate cap is going to cap SOFR. So SOFR is about 10 basis points right now, and will take a spread over SOFR. So SOFR goes up 10 basis points, your interest rate goes up, and it resets every month. So you get a new interest rate every month based on where SOFR is, and then plus your spread. And so this interest rate caps, let's say on a $20 million deal right now, 2% strike rate. So you're saying SOFR is the max of 2%. You'll be at $22,000 right now on a 3-year. If you go out further, right, you go 4-year or even 5-year, it gets exponentially higher. So depending on how long you plan on holding the deal, that's going to determine, do you buy a 2, 3, 4, or 5-year cap? Minimum is 3-year cap, and typically the strike rate is about 2% that Freddie requires. And so when the investor was looking at, all right, should I do a Fannie or should I do a Freddie? We looked at it a couple of different ways, because on Fannie, you're essentially set, right? You're going to go in, get, let's say, a 3% interest rate, 10-year loan, 3 years IO. And if you sell the deal in, let's say, year 2, 3, 4, your prepayment penalty is going to be, it's going to start out at about like 15% of the loan and go down about $500,000 a year. So every year you hold it, the better, right? So, by year 5, it might be a $2 million prepay, which is still 10% of the loan, which is still pretty high. The one thing that isn't in this calculation is that if interest rates go up, so if 10-year treasury goes up, let's say to 3% or 2%, then this number is going to go down significantly. And so that is the one thing that is not baked into this Fannie. This is assuming interest rates stay the same, flat, for the remaining term. Whereas if you look over and flip over to Freddie, the initial interest rate is about 3%, but we baked in about 25 basis points increase over the next 3 or 4 years. And then that additional interest plus the 1% prepay, if you exit the deal in 2, 3, 4, you can see down here that your additional payments in terms of interest, in terms of prepayment, in terms of interest rate cap, that is not going to offset the Fannie Mae prepay, right? So in that first like 5 years, 6 years, you're pretty much coming out ahead on the Freddie side, making these assumptions, right? If this changes, right? If this interest rate cap in year 4 is 250,000, all of a sudden that flips, right? So year 6, all of a sudden that it's better just taking this Fannie loan. And the one other thing to consider here is that Freddie is more conservative on their underwriting. So this loan amount might be 19 million and Fannie might be 21 million. So if you can't raise that additional equity, then Fannie might be a better call for you on this loans. But these are some of the things to think about when you're comparing Fannie versus Freddie in today's market. So here's another thing that is coming up a lot is people are saying, look, I got a Fannie Mae loan and I don't know, I'm paying 4.75 or 5%. Can I just refi this loan into a lower interest rate? And the problem with a lot of the Fannie Mae loans that we've done in the last, let's say 3 or 4 years, is that they have a yield maintenance penalty. And so with that yield maintenance penalty, so on this loan, the current loan is about 7.8 million and it has 30-year AM, has about 7 years left on it, and interest rate is 4.82. Yield maintenance is about 1.7 million right now. So their question was, look, can we do a refi? We think the property is worth about 16.5, and so we're at 50% leverage right now. And so you could go back and potentially do a supplemental loan on your Fannie Mae debt, but right now with supplementals, you're having to put up reserves, so it's probably not worth doing a supplemental. If you do a Freddie Mac floating rate loan, you can essentially get about 50% of the equity on this particular deal out. You drop your interest rate to about 3%. You could get 3 to 5 years IO. And this is key, right? So you get the 1% prepay. So you can't sell the deal for 12 months, but then after that, you have a 1% prepay. So you have essentially the same flexibility as you did with the Fannie Mae loan. Here's the impact to investors. So 2.5 million would go back to investors, but about 475,000 would be held in that reserve account. So Freddie still has the P&I reserves. So it'll be 9 months of P&I. And then this is what's pretty amazing is that your current payment is 528,000 a year, and your annual debt service after this loan, this new loan, after getting 2.5 million back, is 375,000. So your payment will drop from 528 to 375. Your cash on cash on your original investment would increase to 10%. And then you would get your reserves back in about a year. And then you would have this new loan of 12.5 million on an IO basis for 3 to 5 years. And then your cash on cash would improve and you returned half the money. So this 2.5 million that goes back to investors, let's say you hold the deal for another 3 years, that money could be reinvested into other deals, whether the sponsor or limited partners want to invest into that deal. So we've seen, especially like as you get closer on these Fannie Mae loans, like, I would say under five years remaining, and you want to keep the deal, then that's when I would be looking at sort of refinancing to the Freddie Mac floater. All right, so we showed that chart earlier of recourse bank loan, Fannie, Freddie, and then bridge loan. So we're gonna spend a couple minutes on each one and just talk about sort of interest rates and then also how they're underwriting right now, because I think it's important. Recourse bank loans are really for deals not stabilized under 90%. It's under 5 million in loan amount. And then you really need this local sponsor with a strong secondary source of income. So you're either a doctor, lawyer, accountant, IT guy after, and then you're still buying this deal that somebody in your family still has, somebody on the sponsorship team still has money coming in from somewhere else besides its real estate. And so that's very important. The interest rates have dropped, but what's ironic is that you're signing recourse on this loan. It's 4%, 425, which is higher than Fannie and Freddie right now, which is non-recourse. So really people are only doing this on deals that are sort of broken. So we have a deal here in Plano and it's 70, 80% occupied. So it doesn't qualify Fannie Freddie. Still a good deal. But you have to be willing to come in and, utilize a recourse bank loan to take that deal down because it's under 5 million. So that's the first type of loan. As you're getting started, a lot of people use this loan for smaller deals, 1 to 5 million. Freddie Mac SBL, I would say it's 1 to 7.5 million. and it really caps out at about 6 million in most markets. The 6 to 7.5 is for your top markets. So that's going to be, like your New York, LA, Chicago. And what we're seeing in Freddie SBL right now is they are a lot more focused on local sponsors. So they want you to be able to sort of drive there within 30 minutes and have experience. So they're looking for 2 years of experience and like 3 properties that you currently own. Every deal on Freddie SBL has to go into them. All right. And so that takes time. So we like to pre-screen deals with Freddie up front. And this changed sort of once COVID happened was they said, look, let's say there's 10 Freddie lenders on the SBL side. You have to share a portion of the risk. And what that allowed was, Freddie might do the deal at 75%, but the lender was only comfortable at 70 or 65%. So certain Freddie lenders got a little bit more conservative because now they were going to share in the risk on the deal, whereas before they didn't. So understanding who's going to be more aggressive in these times is very important. So we help borrowers do that. But Freddie SBL is still a very viable option. I would say the rate is probably he's right in that 3.5 to 4% range on Freddie SBL due to the size. So those are smaller loans, 1 to 6 million typically. So we talked about Freddie conventional. I would say this is an important point, is that everything goes into Freddie Mac. They are more conservative on taxes and payroll and R&M, things like that. So they're going to ask for substantiation, like in your portfolio, what have you done that proves that you can run a deal at $1,000 a unit on payroll or $600 a unit on R&M. This came up recently. So foreign guarantors, they're a lot stricter on. So make sure you know this. They're required to have 5% post-close liquidity in a U.S. bank account and hold that for the loan term. So let's give me an example. $20 million loan. The guarantors in total need 10%. So it's $2 million. But then they wanted the foreign guarantor to have $1 million in post-close liquidity in a U.S. bank account. And some foreign guarantors will have that, so it's not an issue, or it might be a small loan. But on these larger loans, I would be careful of that. And then, it's going to take some time. So if you want to close a loan, let's say by year end, it's usually going to take at least 2 to 3 weeks to get that final approval. So make sure it's in now. And then in terms of reserve requirements, these really haven't changed since sort of June, July over the summer. Freddie SBL is at 12 months P&I, and then Freddie conventional is at 9 months P&I. And then on assumptions, you don't require reserve, or if you do lower leverage, it doesn't require reserve. In terms of forbearance, it's actually been pretty flat. So I think the best chart is probably here on the left-hand side. You can see April, May, June. You can see a lot of SBL deals go in, some K deals. K deals are your larger Freddie conventional deals. But, it's been pretty quiet the last couple months. So I think people, if they needed it, they got it up front. But then since then, it really hasn't changed that much on the forbearance side for Freddie. All right, so Fannie, what we're seeing Fannie, what's ironic is people are still fixing rates and still taking yield maintenance on these deals because they're saying, this is as low as it's going to get. So if I can get like 2.5 to 3%, lock it up for 10 years, do a 7-year yield maintenance or step down. A lot of people are taking that option just so they can sleep at night. If you do take max leverage, this is really driven by proceeds. So if you're going in max leverage, you get the lowest interest rate. And then if your 10-year treasury goes up, then that yield maintenance will go down. And then we're also seeing a lot of deals on loan assumption. And like there was a deal in Arlington and it was a $4 million prepay. So you could buy the deal at 18 million, or you could buy it at 22 million with new debt. So 18 million on the loan assumption, 22 million on new debt. And, when you go to the county, some of these counties are getting pretty aggressive on taxes. That's going to help your cash flow, right? So if you can buy it for 18 million, show them, you never want to show them the settlement statement, but if you have to, you can at least cap your taxes at that number for that year. Versus if you buy it at 22 million, they're going to bring it all the way up probably in terms of taxes. So here's a spread on a deal that we looked at recently comparing, Fannie, they still have the green program, right? So Fannie regular to Fannie Green, and you can see that the interest rate's about 25 basis points lower on green if the deal qualifies, and it still makes sense for you to do on your CapEx side. If you go with a 7-year yield maintenance on, let's say, a 10-year, it's 305 versus 288. So it's about 17 basis points added to your interest rate. So you just have to run the math and figure out. So what that means is that your yield maintenance schedule essentially stops in year 7, and it goes to like a 1% prepay, I believe, then versus it running all the way to 9.5 years. So it shortens up. It's almost as if you're taking like a 7-year loan at that point. So if you're going to hold the deal, let's say for 4 to 5 years, then at the end, you only have 2 years of yield maintenance left, then it becomes a lot cheaper. And then you can sort of set your rate at 305, which is pretty good. Same thing on the 12-year. So it's a little bit more expensive to take that 7-year on a 12-year. But what you'll see here is on the 10-year, depending on the debt service of the deal, they have to use a 5% floor on a lot of these deals on the 10-year loans, but on the 12-year, they do not. So that sometimes can impact your loan proceeds on a deal. Reserve requirements have essentially stayed the same. 12 months PNI on above 6 million, 18 months PNI below 6 million. So that's been the same. Forbearance, similar to Freddie, we're seeing, it's since June, it's been pretty much stuck at about 4 billion. So 1% of the total loan balance that is out there in forbearance. And the last thing is, some people are still out there. There's still deals that need sort of a non-recourse bridge lender. And what this means is, deals that are sort of broken, but above 5 million, we're seeing people still do bridge loans. There's definitely less people in the market on the bridge side. So definitely reach out to us and we'll let you know who's actually closing these, because if you get stuck, what happened to some people in sort of February, March timeframe is that they had a bridge lender and, once COVID hit, that bridge lender fled. And so we want to make sure that you have someone that's going to close. And before there's any more volatility in the market, we get it done. So if you're above 5 million, we're looking at about 5 to 5.5% all in, and it'll be a floating rate loan. But then if you're under 5 million, there's a lot less lenders, and those people are more hard money lenders. So it's going to be 8, 9, 10%. If you want non-recourse bridge, most people under 5 million are taking like a recourse bank loan, which is the first one that we covered. So I'm going to open it up to Q&A. If you guys want to put your questions in the chat, I got, 15, 20 questions that came in earlier. If you guys have any questions, definitely put it in the chat and I'll try to pull those in and answer those. And if not, I can go through the questions I received beforehand. So I'll give you a minute or so to put it in the chat and I'll just start going through them. All right, let's see. First question. All right. Ryan asks, what is the current state of the bridge loan market? So I would say that it's improving. So we're seeing more people come to the market, more people open to it. And I think it's sort of, once collections came back, people became more. So I would say February, March, before COVID, there might've been like 5 to 10 bridge lenders actively quoting deals. And then it went to 0. And then over the summer, it came back to 1 or 2, and I would say probably 3 to 5 are in the market right now. Let's see. All right, number 2 is Safe S, explain interest rate caps. So an interest rate cap is going to just cap the underlying, let's say, interest rate. So let's say most floating rate loans right now are based on SOFR. So SOFR is about 8 basis points right now. So you buy an interest rate cap at 2%. SOFR, if it hits or goes above 2%, then that interest rate cap provider will actually pay you if it goes above 2%. If it never goes above 2%, then they don't pay you anything. So it's more like insurance, like you're paying the premium upfront. So at close, you pay $25,000. And for the next 3 years, if that interest rate ever goes above that amount, then they will pay you that difference. And so you can take that money and then pay the lender. And so your effective interest rate is capped at that 2%, that strike rate plus your spread. So whatever your spread is on that deal. Dave asks the best way to raise money. So that there's a lot of different ways. I mean, I would say most people start sort of in the syndication um, groups and then really raise it 50,000 to 100,000 a piece. And then as they get more and more experience, they might move to sort of a private equity model where they'll raise money from family offices or larger groups where they're putting in 10% of the money, and then that larger group is putting in 90% of the money. But most of the people that we work with are syndications, and they are raising it 50 to 100,000 a piece from individual investors. John P, compare fixed rate versus variable rate with rate cap. So I think we did that earlier on the slide, and it really came down to the length that you're going to hold the deal, right? So if you're going to hold the deal for, I would say 3 to 4 years or leaning that direction, then that Freddie with the rate cap probably makes the most sense. If you're sort of 5 to 7 years, that fixed rate starts to make more and more sense right now. When is it more favorable to take yield maintenance versus step down? So whenever you take yield maintenance, your interest rate is going to be lower, and that's going to get you more loan proceeds. So if you can take yield maintenance and that's all the equity you have, and you're going to hold the deal for longer than, let's say, 5 years, then yield maintenance will probably work. But if you're in the deal for 3 to 5 years and you can raise the additional capital, then I'd probably take the step down. So most of the time it's on smaller deals that you can do step down. So Freddie SBL, Fannie under 6 million, you can do step down. So I would probably take step down if I'm a syndicator. If I owned a deal by myself and I'm going to hold it for 10 years, then yield maintenance might make more sense because you get a lower interest rate and more proceeds. Malay asks, what happens to loan funding if at PSA the property is at 95% and it drops to 85% at close? So Fannie can still do that deal. It's just that what they're going to do is when collections are going up, they are going to take a T3. And so let's say you have 10,000, 11,000, 12,000 in terms of collections. They're going to take a T3. And that number is going to improve your net rental collections and your NOI and your loan proceeds. But then when it's going the other way, it's going down and your occupancy is dropping, they're going to take a T1. So that's the lowest possible number and annualize that T1 number. And that's going to drop your NOI, and that's going to drop your debt service coverage, which is going to drop your loan. So you can still close, but it's going to put a lot of pressure on your loan amount. Dennis asks, how can a non-accredited investor get started? So there's really two types of syndications. One is a 506B, one's a 506C. 506B, it allows non-accredited investors to work with or invest into those deals. And on those deals, you have to know the general partner already. So I would say number one is you got to know a lot more general partners versus an accredited investor. So get to know general partners, and as you see deals, then if it's a 506B, you can invest in it. If it's a 506C, they are only taking accredited investors. So you're going to have to pass on those deals until you become accredited. Gemma asks, borrow qualification requirements. So at a high level, it is net worth needs to be greater than the loan amount, and your liquidity. So 10% of the loan amount you will need in checking, savings, or marketable securities. So non-retirement. So that is the minimum on the financial side. And then they also want multifamily experience if you're doing Fannie and Freddie. So that is the minimum. And what they do is they look at the entire groups and not just you in terms of borrower qualifications. How will COVID affect financing in the next year? I would say if there's another lockdown, obviously that could drive a lot of the employment down, which is going to take the rents down and occupancy down if there's not a stimulus. So we saw in the summer, even though employment was negative, collections were there because of the stimulus. So I would say it's a combination of COVID and then also a combination of the stimulus. When will agencies remove reserve requirements? So we saw really good collections over the summer, and so they took off that first layer. So it went from about 10% of the loan amount to 5% of the loan amount. Right now, the agencies are doing probably 60, 70% of the multifamily loans out there. And so people are still coming to them. The interest rates are deadly low. And right now, people are just putting up that 5% of the money. And so not until I think other people come into the market, not until that don't require, like let's say you can go get a bridge loan or CMBS loan or another loan that is non-recourse, that has 3 to 5 years IO, 30-year AM, and is at 3%. Not until you can do that will the agencies take those off. And because they right now they're doing the best loans that they can possibly do, because they have a year of P&I or 9 months of P&I protection on top of just their normal underwriting. Like they haven't changed their underwriting besides that reserve. So the loans that they're doing are better than the loans that they did in 2019 and 2020 right now, because there's an additional margin of safety for them as the lender before they will remove that requirement. Abel asks, how do we determine how much we need to close? So what you need to do is put together what's called the sources and uses. On the source side is going to really be your loan amount and your equity. On the uses side, there's going to be things like purchase price, rehab, closing costs. And you sort of have to put those out and balance it out, figure out, the total. And if you need that spreadsheet, just send me an email and I'll send you a sample spreadsheet. George asks, when is the best time for lenders to get involved in the deal? Really, when you start looking at the deal, you think this is a deal that you're going to make an offer on. Send it over to us. We'll take a look at T12 rent roll, purchase price, and determine, is this going to qualify Fannie, Freddie, bridge, what type of loan? And that's the best time to get us involved so we can sort of help you through that process, help you win the deal. And make sure you don't make offers on deals that you can't finance. So let me go to the chat real quick and see if there's any questions here. Okay, the question around suburban versus downtown from Vivek, I would say, so that was really around vacancy. So what they're seeing in suburban versus sort of downtown areas is that the vacancy has always historically been better. The occupancy has historically been better in downtown because there was only so much space, right? And in suburban, there was always new construction, the vacancy was always higher. But now, as people move away from the cities a little bit and more into garden style suburban properties, the suburban occupancy is better. So that was what that chart was showing. Tony, in terms of signs that Fannie will ease P&L withholding requirements, nothing right now, but it could change tomorrow. And so I think there's a couple things that are probably on Fannie Freddie's mind right now. One is they have a cap that they are given in terms of lending per year. So this year for Fannie and Freddie, both of them got about 80 billion. Right now they're at like 50 billion. So I think they're fine for this year. We have no issues with that. They have not been given their number for next year. So that's one thing to be on the lookout for. And then right now they're public sort of government agencies or entities. And so if they go private, then that might change some of these requirements as well. So right now we haven't seen anything. Gemma's floating rate, can you explain how that works then differently than a locked in rate? Yeah. So on the floating rate, Gemma, they really, every month you're going to get a new interest rate. So they're going to take the underlying base rate, let's say SOFR, which is 10 basis points. And then let's say your spread is 300 and it'd be 310 for this month. But then if SOFR goes to 15 basis points, it'll be 315 the next month. So it's going to float up and down the same way SOFR does until you pay off the loan. So it's going to change every month. Let's see. All right, Noah asks, how are you underwriting worst case scenarios for your deal? So I would say, a lot of people, when COVID hit, they sort of did, all right, like how much can revenue drop and I still sort of break even and don't have to feed the deal. And that usually hit at about 70 to 80% occupancy. So I'd probably run it at that number. I mean, we haven't seen anything that bad, but on worst case scenarios, I mean, nobody expected COVID. I mean, you can do either occupancy shocks, you can do rent growth shocks, you do cap rate shocks. Those would probably be the main drivers of what's going to determine majority of your downside scenarios. So that's what I run it at. All right, I think we'll wrap up with a couple more questions here. Sariram asks, what factors determine the loan proceeds? This is really driven by your debt service coverage. And so it's going to be, let's say your debt service is 100,000, your net NOI or net cash flow needs to be 125,000. So it needs to be a 125 debt service. And so if your debt service, if your NOI goes down, it qualifies for less proceeds. And so they're going to underwrite the NOI and then figure out the debt service coverage. And it needs to be at least a 125 for Fannie and Freddie. Richard asks, what is the maximum LTV you've seen for partners with little to no experience? So Fannie and Freddie can go up to 80%, right? But what we're seeing is if for whatever reason you guys come in, you have one or two deals that you've done or limited experience or not local, then they are cutting that leverage back. But it might be 5% or 10%. So you might get a 70%, 75% loan. So if I had little to no experience, I would either bring in somebody who has more experience, or I would bring in someone with more experience, or I would use lower LTV on my projections to get that first deal done. So we talked on the worst case scenarios. Andy asked, what deal does not qualify for a deal that doesn't qualify for agency loans? What options are there? So it's really going to be on the sides of that chart. It's going to be your bank loans, recourse bank loans, or your non-recourse bridge loans on deals that don't qualify. And then Aaron asks, how do I get started? I would say, sort of figure out what you want to do. Number one, do you want to be a general partner or limited partner? And then after you determine that, let's say as a limited partner, your job is really just to find general partners to invest in. So that's what I would say is number one as a limited partner. And then if you want to move into a general partner role, there's really four things that you need, right? So you need a deal, you need equity, you need net worth and liquidity, you need multifamily experience. And so depending on which ones you have, you need to find partners who have the things that you don't have. So that's would be my advice, Aaron, on that. What are the challenges and solutions for first-time syndicators? So I would say the biggest challenge for first-time syndicators is finding a deal. So finding a deal, a listing broker is not going to give you a deal unless you've closed. So it's you're sort of chicken and egg stuck in that situation. But I would say the partnering with someone who has closed with that listing broker or closed in that market is going to help you the most. Same thing for raising equity. You have to go out there and raise money, and leaning on a experienced partner and then also experienced property management company is going to help you the most. So let me see if there's any more questions in the chat. All right, I think that was it. Let me see. So a couple things just on Old Capital. I would say we are a mortgage broker, so we help you find the best deal, whether it's Fannie, Freddie, Bridge, CMBS, HUD, construction. We do a lot of education. I would say our podcasts, we just had our conference with 500 plus people. We're going to start having sort of a monthly, quarterly speaker series online. We do a bunch of stuff on YouTube. So whether it's quoting deals, walking deals, helping you win the deals, we represent you, the buyer, solely. And then, post closing, whether it's highlighting you on our podcast or conference or Facebook group. And we charge the same as everybody else. We charge 1% of the loan amount at close as our cost. And so definitely, if you need help with a term sheet or deal review, send me an email. I need T12 rent roll OM. Or if you have a question on a deal, send me the investment package. I'll give you some tips on how I would underwrite the deal. And, getting pre-qualified, send me a personal financial statement via email, and we can set up some time to talk. So I'm going to open it up to you guys now and just let you talk and introduce yourselves if you don't mind. So I think, let's see who we got. Abel, are you there?
Yeah, how's it going? Can you hear me?
Good. Yeah, you're good.
Hey, thank you for sharing. As always, I appreciate it. You give a lot of nuggets on the YouTube, but my name's Abel Pacheco. I'm a general partner principal for 5 Talents, and I am syndicator, raising capital as the primary kind of get principal in our deals, about 800 doors, and involved passive investor and also an active investor. So I see a lot of familiar names. Nice to see everyone.
Abel, where are you based, and where do you invest?
San Antonio, Texas.
Okay.
And pretty much all the 800 doors today are in Texas, in San Antonio primarily. And then we have a couple of hundred other doors under contract outside of Dallas and then in McAllen. And we have a new development or construction that's kind of a slow moving COVID deal in New Mexico, but haven't broken ground on that project yet.
How are you planning on financing the deals you have under contract right now?
We basically used a couple different lenders like Peak Financing, broker. I do that as well on the side, so
Yeah.
just learning as much as I can. But yeah, agency debt, bridge loan before COVID, and then HUD for construction.
Okay, good. Malay?
Hi guys, this is Malai. I live in Los
Malay.
Angeles.
I always mess that up.
Okay,
Malay. All right, go ahead.
So I live in Los Angeles. I see a lot of people that were in the old conference. Old Capital conference. I have an IT company that I run full time, and my partner and I, he's based out of Dallas. We're looking for 40 units, around 40 units for our personal portfolio. And we have a portfolio of single family homes, and we do first and second non-performing and performing loans and hard money lending. But we haven't done anything in multifamily. We have been consuming a lot of content, and we've been chasing some deals. We have even started to look outside of Dallas because it seems like the deals that we're looking at around 40 doors seems to be pretty crazy.
Okay. Noah?
Hey, I'm from Oregon, sell residential real estate. Been doing multifamily for probably 2 years. Invested in 140 units in Lake Dallas, Texas, and 120 units in Simpsonville, South Carolina. I'm part of the Brad Sumrock group. And then I've invested with Grant Cardone too on his deals.
How does Grant Cardone compare to other general partners?
Yeah. Monthly distributions.
All right.
The one I did at least was a 65-35 split. So you're getting better splits with other syndicators. A-class, he's buying A-class properties.
Okay. No, I think that's what's unique and different is that if you are a first-time syndicator, and I didn't probably address this in that slide, but you can't take a 65-35 split. If you're first-time syndicator, you're probably 15-85, right? Like you need to get a couple deals done, and then as you do more and more deals, then you can increase that split. So for Grant Cardone, that's just a straight split, 65-35, and on cash flow and sort of any sale or refi.
He ran originally was a Reg A plus fund for non-accredited. So that was my first deal. Like getting into it still counts as like the limited partner, I guess, as far as taxes and stuff.
Right.
So that fund was a straight 65-35 split. His accredited, now he's opening up to like 80-20, and then there's ranges from like some preferred returns, 65-35, 6% pref. So he's got a couple of them, but.
Anything you've learned from your investment? How long have you been investing as a limited partner?
With him, it's been about 2 years.
Okay.
And then the other ones, the past 6 months.
What have you learned from being a limited partner?
Financials. So just getting in there, you see exactly how they're breaking it down. You get like the T12 the income statement. You get your monthly reporting, and then just I guess doing it. And then probably the most education came from just talking to people. So talking to people within the group, and then who are also doing deals, and then watching the webinars. That was hugely important. Questions like the Q&A at the end. That seems to be the
like what's bothering people, right?
yeah, exactly. Yeah.
What's bothering people about this deal? Yeah, like we don't need any more details about Dallas Fort Worth in your webinar. Just like let's talk about the deal. Like I've been on some webinars where it's like we spend 45 minutes on DFW. I'm like, I got it, it's in DFW, but like let's talk about this specific deal and let's get into it. So, all right, thank you, Noah. And sorry, you're in Oregon again?
Yes, correct.
Okay, awesome. Thanks for joining. Joe?
Yeah, can you hear me?
Yeah, you're good.
Awesome. Hey, everyone. My name's Joe Belady. I'm living in Atlanta right now, so not quite in the Texas market, but it seems to be a pretty popular market. I'm LPing in 82 units and looking to GP my first deal. So, putting together a small team and hunting for deals around here. And James, I know Clay Allen.
Yep.
Him and I talk regularly now. I'm really glad he connected with me. So, Atlanta market. I'm working corporate W-2 at the Home Depot headquarters and just trying to get that first deal underway as a GP. So nice to meet everyone.
What's the biggest challenge besides the deal?
Besides the deal and raising capital with COVID reserve requirements and everything like that, I would say, I see myself as being an asset manager. I'm really, I really am interested in that role. But coming to the table looking for that first deal, you really got to be good at underwriting and you got to be fast at it, to be efficient. And that's where I'm at right now. I'm trying to hone my skills in on being able to evaluate deals quickly and move through them, because you could have awesome deal flow, but if you can't crunch the numbers quick, it's useless. So,
Joe, it might be interesting in that a lot of people who live, let's say in Dallas, they want to buy in Atlanta, but they are not there.
Call me.
and they might actually have properties there right now. So you could potentially be the asset manager on those deals. I don't know if it's too late, but people who have bought deals, let's say in the last like 2 years out in Atlanta, and they just need someone sort of boots on the ground there because it's more difficult to hop on a plane and get out there compared to 2019. Right. So that might be an opportunity. And then you could potentially partner with those people on future deals. And then, you could leverage their experience and get better financing terms, if that makes sense.
Absolutely. No,
Okay.
I'm all
Okay.
about that. And
Okay.
I know it helps. I am a military veteran. I don't know if I mentioned that, but a lot of investors like that. So I figured I'd mention it.
Joe, send me and Clay an email just referencing this conversation, and let me try to connect you with some people who are in Dallas but own in Atlanta.
That's awesome. I appreciate it. Thank you.
No problem. Vivek?
Sure, yeah. Hey, I'm Vivek. I'm based in Dallas, also part of Lifestyles Group. I'm limited partner in about 350 units now with about 3 deals, all in Dallas. And I'm looking for my first deal as a general partner now. I've submitted LOI on 1, just waiting for the response. It's just a typical mom and pop shop. So the brokers say just sit back and relax for them to.
Is it off market?
It is off market.
Okay.
Yeah, it's been a quieter ride, as you said. Brokers don't know you, so you got to just get out and keep knocking the doors. That's what we have been doing. So yeah, still looking. I don't know how the LOI goes, but still looking for some deals around 50 units. I think sometime back you and I exchanged some emails on that. So thanks for sending some notes.
So how many LP deals are you in right now?
3.
3. And what is making you move towards, on the GP side, are you buying your own deal? Is that why you're limiting it to 50 units?
No, I'm going to syndicate it.
You're going to syndicate it.
Lifestyles itself. Yeah. I mean, I've been an entrepreneur before. I've had my startups and moved on from them. And I look forward to doing this as a full-time now.
Okay. So you just want to, before doing a 200 unit, just sort of start with the 50. Okay. I got you.
Yeah. I definitely want to manage it on my own as well, to just get my hands dirty and learn it. And then from there, just go up.
Okay. Andy?
Hey, my name is Andy. I'm part of the Sunrock Group also, located here in Dallas. Also, let's see, I'm an LP in 1 deal that's down in Corsicana, 211 units. Currently looking at my second LP deal right now, looking at a few that within the Sunrock Group. And also working on my first GP deal. Probably gonna submit an LOI at around like near the end of the week. So probably just reach out to you before then too.
Yep. No, that works. What is, when you're looking at deals as an LP, what is sort of the top 3 things you're looking for as an LP?
The first thing is the sponsor team. So I actually, I was looking at a lot of other deals like prior to probably selecting the one that I'm probably going to sign today.
Okay.
And the deals, I mean, like whenever you attend the webinars for any of the deals, right? They all sound great because they're selling it.
Everybody's great. Yeah.
And then once I like start talking to like trying to get some more questions, get clarity on like the underwriting and things. And then I noticed like some groups are like, hey, like I'll ask, why did you underwrite this way? And like, whatever. Right. And then some people just don't respond. And then I'm like, okay, that means like, I'm not going into that deal for sure. So first is obviously sponsor team. Second is the deal. Like if the deal makes sense, obviously from not just their perspective, but, more review. And then probably the third one is location.
Do you plan on partnering with anybody you're investing with?
From the LP side or?
Yeah. So like you said you were going to move into being a general partner, right?
Right.
As a general partner, are you going to buy your own deal or are you going to syndicate a deal?
No, still syndicate.
Still syndicate. Okay.
Or like if it was smaller, I was talking to a few other partners to potentially JV something if it gets small enough.
Okay.
But yeah, probably looking more on the syndication model.
Yeah, I mean, if you're gonna, what I would think about is before you invest with that general partner, obviously you like them and you like the deal, but potentially asking them, hey, if I find a deal that's 100 units or 150 units, will you sign with me on my deal?
Right.
And I would be more inclined to invest with somebody like that versus just somebody who, they're not. I guess.
Right. Bring that deal to the table first, and then.
Yeah. Because if you're in between 2 deals, right, and one person you could potentially partner with next year, and the other person's like, no, like I'll raise my own money. I don't need your help with anything. Then,
right.
But somebody who's more open to that might be a good fit. So,
cool.
All right, awesome. Is it Gemma or Gemma? How do you say it?
It's Gemma.
Gemma.
Yep, the G sounds like E, which is in Spanish.
Okay, sorry. It's from Spanish, you said?
Right, it's in Spanish.
It's in Spanish. Okay, all right. Go ahead. Sorry.
All good. I respond to all the names, so it's all good. Hello, everybody. My name is Gemma. I live currently in Arlington, Virginia, so close to the DC area. I'm a LP in 2 different deals, about 130 units, one in Texas, one in Virginia. Been invested in real estate, but not in the syndication or multifamily until the last year or so. Just hold rentals, do private lending, that sort of stuff. And yeah, I'm active duty military. I'm actually on my lunch break watching your webinar and being here. I am also looking to, like Joe, looking to get on the general partnership side here in the next year or so, or 6 months. And yeah, that's pretty much where I'm at.
Where are you looking to buy?
Right now I'm first who, then what. Looking to figure out folks who I can partner with. I'm really, if the deal makes sense, I don't really care where it is. And so I'm trying to find who I'm aligned with that complements my skill set. I'm sort of in the accounting, numbers, underwriting, that sort of thing is my strength. And so that's kind of where I'm at. So I can't tell you exactly where. If I were to give you a first stab at it, it would be probably Southern Virginia, Richmond, Virginia, just Virginia Beach area, because I'm close to that, in the eastern side of the country.
Is there any like groups, meetups, anything out there on that side of the world? Texas is a whole different country, so like there's plenty of stuff here in Dallas, but I don't know on that side of the coast. Have you been going to any of that stuff, like to meet other people that are local?
So locally, I mean, the virtual stuff is is still going on. The actual in person has gone off completely. But I am networking through like LinkedIn and ADPI, and so getting my education and networking in that way. So there's
What was the second thing you said? You said LinkedIn and what?
LinkedIn and ADPI is Active Duty Passive Income is a
Okay.
group that I don't know if you've heard of them, but anyways, they have just a community of military members who are pursuing multifamily, mobile homes, that sort of thing.
Wow. No, that's great. How long have you been in the military?
Oh gosh, 17 years now.
Okay. Did you listen to our speaker at the conference or no?
No, I
Okay.
did not.
I'll send you a link to his speech, but I think he was in, so he was a Top Gun instructor, and then he was a speechwriter for Secretary of Defense Mathis like 3 years ago or something like that.
Mm-hmm.
So I'll send you his video that he did for us though.
Awesome. Yeah.
Yeah.
Appreciate it.
Thanks. TJ?
Good morning, everyone. And James, thank you for doing this. I appreciate it. I'm sorry for coming late. I missed part of it, but I think we're doing intro, right?
Yeah.
Okay. My name is Tanvir Janjua. I go by TJ. I've been doing real estate investment since 2012. We started off pooling our money with a few friends and formed an entity, bought a 16-unit building, and then we expanded, bought it a 32-unit, and then 60-unit. So now we own about 600 doors in the last 8 years. But
Where was the last deal you bought, TJ?
I'm sorry?
Where was that last deal you bought?
The last deal, which we got out of syndication, that was in 2016, 124 unit in Houston.
I was in Houston. Okay. How's that deal going? Where is it in Houston?
I think all the deals are going. Most of the deals which we got, initially very heavy value add, and we paid very, I want to use a word, bargain price, if there's some such thing. And then we ended up injecting a lot of cash for improvements. And so our baseline and loan amount is very low. So even if our economic vacancy goes down significantly, I think we'll still be okay.
Okay. All right. And then where do you live, TJ?
I live in Frisco, Texas.
In Frisco. Okay. So
yeah,
good.
And,
close to me.
Yeah, and part of the Sumrock Group in Dallas here, and we just got my first syndicated property under contract. It's a 28 unit in Fort Worth, and we're doing the due diligence this week.
Okay, great, awesome. Let's hit the last one. I think Joel, are you there?
Hey guys, hey James.
Hey.
So yeah, Joel Fine here. I'm an Austin-based investor, Austin, Texas. I'm LP or KP on about a dozen deals, total of 2,500 doors. Looking to do GP on my for the first time. Looking all over the Texas Triangle and other parts of Texas, aiming for 60 to 120 doors ideally, but I'm willing to go smaller if that's what it takes to get my first deal done. I'm also part of the Sumrock network, so I've connected with or spoken to probably about 60 or 80 fellow Sumrock students, looking for folks who could either co-sponsor with me or just be fellow investors on a deal.
Joel, what did you think about that deal in Fort Worth that you sent me?
Let's see. So that's the Santa Barbara apartments, is that right?
No, it was the one in White Settlement.
Oh, White Settlement,
units.
yeah.
Did you get any traction on that, or where did it end up?
Still trying to figure out how I'm still trying to figure out what the upside is on rents.
Okay.
Because the data I've got suggests that the rents are already about at market, but I think the OM suggests that you can bump rents a little bit. So
of course, what OM doesn't have higher rents?
Yeah. So I've got to figure out if that's justified or if it's not, then the underwriting doesn't really work.
Okay. All right. Let's see. Tony?
Hi, hey, I'm Tony. So I'm based out of Silicon Valley, California. So started out as a passive investor. So I'm LP in about 10 deals, close to about 3,000 doors in total. But I also invest in different things like self-storage and even a commercial plumbing company. So I try to get myself into different aspects of investment so I can learn about all the different ways that people are investing. So I'm also sponsor and co-sponsor on a couple of deals and also KP on a deal. So currently sponsor and co-sponsor in about 350 doors in the Dallas-Fort Worth area. So yeah, and continuing to look.
All right. I think I got everybody. So I appreciate everyone joining. I'll send out the recording to everybody just in case you missed parts of it. And if you guys need anything, send me an email.
Thank you very much for doing this, dude. Always good value, bro.
All right. Thanks a lot, guys.
Thanks, James.
Yeah, thanks, James.
See you guys.
James.